Welcome back, everyone. Today we bring together some accomplished investors who have shaped industries and backed category-defining companies. Craig Shapiro, there next to Jorge, is the founding and managing partner of Collaborative Fund, an investment firm managing over $1 billion in assets with portfolio companies including Lyft, Reddit, and Beyond Meat. He was also an early investor in companies like Facebook and Kickstarter. And then to his left is Eddy Chan, the founding partner of Intudo Ventures, the only fund exclusively investing in Indonesia. Eddy has also invested in companies like PayPal, Palantir, and Affirm. He holds a JD from Georgetown University Law Center. Go Hoyas.
To Eddy's left, Hoya Saxa. To Eddy's left, we have Marcie, who is a partner at Greycroft, where she focuses on software investments. Previously, she led Catalyst's consumer tech M&A group, facilitating deals such as LinkedIn's sale to Microsoft, and playing a critical role in IPOs for companies like Facebook and Google. We also have Tobi, who is a partner at Felicis Ventures, investing at the forefront of enterprise technology, infrastructure, and biotech. He's recognized as a Business Insider Rising Star and a Forbes 30 Under 30 honoree, and holds a bachelor's from Georgetown University.
Woo!
Please join me in welcoming our panelists.
We're first going to start with a question for the entire group. Some of the best companies have been built during downturns. Airbnb, Stripe, Uber, and WhatsApp all emerged during economic slumps. What advantages do founders have when building in a down market, and how should they approach fundraising differently today? Anyone can take it.
Well, first of all, thank you so much for having me. This is a lot of fun, and it's great to see so many people. I think building in a downturn actually is a huge advantage because there's just less capital, and so you've got access to more resources. Like money becomes a moat in the sense that the companies that are able to successfully raise don't have as much competition. When money's flowing, all of a sudden 2, 3, 4 competitors crop up, it feels like all the time. Also, it's easier to attract talent. In a downturn, there's more great resources available from a human resources perspective. So it's not surprising the list and there's many more. So yeah.
Mm-hmm.
I'll add.
Yeah.
I think constraints allow you to really focus on what's important, and it forces you to be disciplined. It forces you to think more long term. And so a lot of times when you have too much capital, you are diluting. For example, you're throwing money at marketing spend versus really focusing on a product that's really delighting users. So I think, and it's the story of entrepreneurship, which is when you are constrained, you really focus on building and really delighting customers versus a lot of other potential noise that can enter the system when you have too much capital.
Yeah, just to add to that, I think Marcie said it really well. Constraints breed innovation. If you raise ahead of traction, then you do things to justify that traction versus focusing on building and delivering customer value. And there's numerous examples of companies in the Valley that raised large rounds out of the gate that then felt like they needed to justify those expectations, and they lost sight of what they were actually building towards. And so proper stage gates, proper metrics can be valuable as you grow the company.
Great.
So talking about capital efficiency, how is AI automation changed startup thinking around headcount, burn rate, growth? And can it create a new type of capital efficient company that can achieve significant revenue without relying on traditional seed, Series A, Series B funding?
On mine, I can talk a little about that. I invest in 2 markets. So on the Indonesia-only side, 100% capital, $400 million for the Indonesia strategy. And what we found in that market, given that's an emerging market and GDP per capita of call it $5,000, I think on the AI side, it's not necessarily as important to us. I think that's for customer delight, yes, supporting the customer, but in terms from a cost savings perspective, yes, let's say you enable something so that you can have one less person in your parking lot that manages security. Well, in reality, you're paying that person $200-300 a month, right? So, in the Asia side or in the developing side, I would say that I haven't seen much, but certainly in the context of our portfolio companies that have more of a U.S. nexus, all of the dual use stuff, rather back in the day, Palantir, we're investors in each of the 3 defense tech companies earlier this morning, working with them on global go-to-market. We've certainly seen, I think it'd be quite additive there from a headcount perspective and achieve and run a lot faster than maybe what we saw a couple years back. That's what, at least personally.
I think it depends on the business that you're building. There's certainly situations where you should be leveraging AI to be more efficient. So we seeded a security AI business called Reckon, and it's 5 people right now, and they actually don't need more right now. They're enjoying this cohesive group to build, and so using tools like Copilot and other coding tools, they actually can delay needing to hire. Now, on the other hand, you do have businesses that are state-of-the-art in building foundation models, and so certainly AI in that case is a different unit economics model. But at the end of the day, if you're a technology company, you should be figuring out how to use AI and leverage AI in your business. And I think a lot of times, I don't think it means, oh, here's AI, then all of a sudden you don't need funding. It takes a lot to build an enduring business and to build the product, like have technology differentiation, build go-to-market, et cetera. So it's quite a long way to go from, oh, here's a model to an actual product or service.
I want to press on this just a little bit more. Do you think that the venture model is adapting fast enough or with the way that startups are changing?
Like, are we using the tools, et cetera?
As the way that you kind of profile a successful company via headcount or whatnot, through AI and how that automation is changing those kind of metrics. Is the venture model adapting? Is the way that funds operate adapting?
Yeah, I mean, I'll take a shot at this. I think the advice that you would have gotten 20, 25 years ago in terms of the things that you need to set up and the infrastructure you need to set up to build a successful business, I mean, yeah, it might be slightly outdated insofar as Marcie's right. There are several companies in the Valley that have scaled to 0 to 10 or 0 to 20 or 0 to 50, and we can talk about the legitimacy of those revenues, but with 5 to 10 people. Mm-hmm. So it's less, back in the day, the Sutter Hill model was, we'll seed you, and then we will surround you with excellent salespeople that help you go 1 to 10 or 1 to 100. Founders these days are a little bit younger, they're doing different things, and so you do have to adapt your advice. I think the capital formation and the capital that we provide still is valuable. The advice might need to change, so.
I don't know if the question is the model changing. I think one aspect is, of course, we need to be leveraging AI to improve how we evaluate companies, find exceptional founders. Mm-hmm. But I think like in any major technology shift, you have to think about, well, what does this mean? And I would say what's different this time around is that the rate of innovation is so fast that what you may have believed 6 months ago may no longer be true. And so that is like, I don't know if the model is changing per se, but it's more how do you think about what is a durable business? And just because you quickly ramp to 10 million in revenue, you have to ask, is that durable? Like you said, the quality of the revenue. So I think the bigger challenge is, like, what does it mean to be successful as an AI first or AI native company or AI accelerated company? And I think we're constantly testing ourselves because we don't know, or like the assumptions are changing so fast. And what we are excited about is that because the rate of innovation is so fast, including the things that happen with DeepSeek, like we're super excited because that means that companies can be built at lower prices and require less funding. And so, I don't know, I think it's more what is long-term durable is something we're constantly testing our assumptions.
Yeah, I would add, I think AI has kind of taken on this almost cultural phenomenon. It's like you can't have a conversation with anybody these days without AI becoming a part of the conversation, and it means different things to different people. For some people, it means ChatGPT. For other people, it's machine learning. For other people, it's data center usage. So it's an interesting question because AI is a very amorphous thing, and I think at the end of the day, investing in a business is you're trying to find people who can create value by selling a good or service and do that profitably to create value for shareholders. Sometimes there's going to be new technologies that come along that expedite that, make that more challenging, more competitive, less competitive. So I think AI it's kind of the flavor of the month, but I don't know, from our perspective, I really try to zoom out and understand, okay, does this company need it? Like as Marcie said, it's really a case-by-case basis. So is venture adapting to AI? It's kind of a complicated question because I think it really depends on the sector and the types of companies. But yeah, I think it's changing everything. Are universities adapting? Are individuals adapting? Like it is. There's so much rapid innovation that I think we're all trying to figure it out in real time.
So we've talked about venture looking for AI companies, but when it comes to AI companies for venture investing, especially in a field that's as founder-centric as venture capital, how do you see AI helping the investment process?
I mean, I'll go first again real quickly just to kick things off. It is, I mean, really anything that requires like rote memory or just basic analysis, some of the tools that are coming online are making that much easier to do. So even looking at OpenAI's most recent release of Operator and deep research, like so many of my peers are using those tools, as are we. So yeah, it's an exciting time. It's an exciting time to both be an investor but also an entrepreneur because you now have kind of a new set of tools that enable you to spend your time in more creative spaces. That would be my take.
Yeah, I can comment a little bit. I mean, I wrapped up undergrad like 20 some years ago, and I remember the comps, when you're doing comps as an investment banker, whatever it would be. And back in the day, the 10K or, the Q came out 45 days after the quarter, and people would ride it around like a courier, literally. And then even, if you think a couple years, prior to, ChatGPT, when we would review companies, my team would prepare the IM, et cetera. We'd have to, run comps. Maybe yes, there's Cap IQ, et cetera. But some of the stuff's pretty powerful. Of course, you got to fact check it. But if you look this year, I would argue last year when we did our annual meeting and prepared a lot of the underlying data in the tables, I asked the team, like, did you guys? It took them a fraction of the time. I kid you not, it might have been like a fifth of the time to prepare for that annual meeting that used to be such a drag for our whole team. So for us, we found it to be pretty effective. Obviously, we do you fact check and you got to do your own sanity check, but it's dramatically made it more efficient running our own venture firm. And in terms of sourcing deals, I mean, for Indonesia, for good or bad, there's 100 companies that raise more than $1 million a year. That's probably like 1 square foot in San Francisco. And we have the largest early stage team in the country with a team of 10 with 100% retention. So I kid you not, if we each meet one company a month, we cover the whole market. So to that end, it's not useful for me for sifting those type of things, but I could see that being very valuable if you're a very volume-driven investor, let's say in the United States, to sift through a lot of the noise.
So I think the fellow panelists covered a lot, but I mean, it's like in any business, it's like, how are they helping with research or like that first draft or trying to sift through hundreds of pages of research reports, et cetera. And so it's that experimentation in terms of figuring out like where is it really useful, where is it not, but also how do we work with our own portfolio companies to use their products and services. And one big area is just how do you ingest board decks, for example, and create templates that used to be pretty time-consuming from an investment professional perspective. And so, I mean, I think all of us are just trying to use all the tools that we can and also balance whatever privacy guardrails our IT teams may be impressing upon us. But it's like most companies, you gotta leverage the tools that are available.
Have there been any obstacles to kind of implementing AI across your portfolio companies to date?
Data privacy is one that companies think a lot about, that we think about internally. I'd say that, and sort of some tools get met with initial skepticism. An example would be like an AI SDR, right? Which is a sales development rep. It's for outbound calling and generating leads. Some folks think that works, some folks don't. Then they try it out and they figure out the use cases. But I'd say the major blocker is data privacy, or major concern, I should say.
Are you talking about a company internally or externally with customers?
So I'm thinking internally, like you invest in a company, you see opportunity for them to leverage AI tools as that's kind of the popular thing to do. Are you working at all with your portfolio companies and the founders to implement either other portfolio companies across your portfolio within them with using AI?
I think they're doing it themselves. I mean, if you're, we're a technology fund, so if you're not using AI, then what are you doing? And so it kind of depends on the stage of the company, but at a very base level, many of them are using it for personalization, for discovery, for trust and safety, for customer support, and how do you continue to scale these important elements in the business. But from an external customer perspective, it's like, you gotta crawl, and then you gotta walk, and you gotta run. And I think in addition to like data privacy and security, it's really, it's easy to do a demo. It is harder to put something in production at scale across an employee base and have reduced hallucination or a minimum threshold for accuracy. And so I think that's the bigger challenge with Fortune 500 companies, for example.
So when it comes to the application layer of AI, I think there's been a lot of skepticism towards GPT wrappers, especially regarding their defensibility. But if we look at past tech cycles, a lot of software businesses are essentially wrappers on foundational infrastructure, right? AWS is a wrapper on cloud compute, and Salesforce is a wrapper for databases. So going back to AI, what distinguishes a high-value AI application company that's building on top of an OpenAI Anthropic model from just a commodity wrapper, and how do they create advantages for themselves?
I'll tell you how I think about it, just in its most simplistic form, to kick things off and give my panelists time to think about it. But the most simplistic way that I think about it is, as the kind of large language models improve, if that is detrimental to your business, it's more of a feature, and it's going to be really difficult. If, as the large language models improve, that is accretive to your business, then that's a good sign. So like, as OpenAI, Anthropic, and others are more capable of doing more things, if that is encroaching on whatever product or service you're providing, that makes it difficult, at least for us, to look at from an investment perspective. So it really has to do with just that very basic question. I don't know if that makes sense, but yeah.
I'll go at it. First of all, I disagree that AWS is a wrapper. They actually had to build their own data centers and cloud infrastructure to do consumer web scale. So that was actually something that they fundamentally built and then made it externally available. So anyway, putting that aside, I would say that a model is not a product. And so I think what we've seen through open source and other businesses, that you can leverage these models, but a model is something that you can leverage and then actually create a product for a user. So the model in and of itself doesn't do anything. And so if you are fundamentally creating a product that is delighting a user and solving a real problem and creating a value prop, then that's a different thing. So a wrapper company by definition is not, I don't think, sustainably delighting a customer. And so I guess like that's my first comment, which is you need more than a model. And then the second thing, something that I always think about is, I wonder what OpenAI will do and how might that impact the competitive landscape, and therefore, like what is this particular company, what are they creating that's actually differentiated? So I really do, because OpenAI is actually more than just a model company. Obviously, ChatGPT is one manifestation, but they're going to keep doing more. And so I always try and think about, what is it about this company that gives them an advantage over maybe someone like an OpenAI? Or if something is like in the middle of the fairway for OpenAI, I really need to think twice about, is that a good idea to invest in that potential company? But I think fundamentally your question is, and it's not just it's not just wrapper businesses on top of AI models. It's like, you gotta really do something that is valuable to a customer. And if you're just a wrapper, then you're just fundamentally not.
Yeah, just to pick up on those 2 points that were really well said. I think there's different flavors or ways to differentiate. So you have, your application layer companies that are utilizing models under the hood. There's a whole set of infrastructure that makes those models work and integrate together. There's also integrated model companies. Like one of our investments is a company called Runway ML. And they've sort of built their own model that allows them to then leverage to the end consumer. And another company in our portfolio, Poolside, is a code generation company. They built their own model in addition to drafting off of Anthropic and OpenAI that enables them to have a competitive differentiation. I think in addition to that, solving the last mile problem for the consumer is actually really difficult. Like building workflows that move the needle for your end consumers is non-trivial. And companies that get that right, I think, Harvey as an example in the legal space, like they built a delightful product. Is it that differentiated in the end? Maybe, but their product is excellent, and that's why it resonates with consumers. I think the second way that you can sort of think about it, and this is less common, I would say, for most general use cases, is do they have access or a way of generating data that is proprietary to their product that then they can then ingest and use that to improve their product. So that's the way that we think about it. I think to Marcie's point, like if it's squarely in the roadmap of something OpenAI can do, you have to think 2 or 3 or maybe even 4 times before you invest. But there's different ways of generating differentiation at the application layer.
I want to ask the next question to you, Marcie. So you've served on the boards of Scopely Gaming, which is a gaming company, Whatnot, which is a live shopping company, and took Facebook and LinkedIn public, all platforms that are built on community engagement. How have you leveraged insights from these diverse industries to advise other companies in creating thriving communities and engaging high customer engagement?
So I think community, and especially those that are durable, is another way to say that's a moat, both from a customer acquisition perspective, and you're taking advantage of network effects. But the strength of a community is really hard to displace, and it's not something that can be built overnight. So there are many elements of that, which is, well, then you have higher engagement and retention, et cetera. But I mean, time over time, we've seen businesses that have really strong communities, whether it's GitHub with the developer community, Facebook, obviously with friends and family, LinkedIn with the professional graph, Scopely with thriving, it's more separated communities depending on the game that you play. Whatnot is durable communities of passionate sellers and buyers. It's just, it's really durable moat. You can't build this overnight. And then you have advantages with respect to customer acquisition. So I don't know if I answered your question.
You did. It was interesting. I mean, I guess you're right. You have to build that moat. That customer base is kind of your lifeline when it comes to some of these types of companies.
But then it kind of fundamentally goes back to they created something that is of value, and therefore you have people who are returning and are enjoying being part of that community.
Yeah.
I want to ask Eddy and Craig, both of you started your funds, Collaborative and Intudo, in areas that many investors initially might have overlooked. Indonesia's local market for Intudo and conscious consumer products and climate for Collaborative. What drove you to invest in these niches?
Sure, yeah. On my end, I would say it's really kind of a tale of serendipity. I mean, I think back to this whole Indonesia stuff. In 2010, when I was covering a lot of the major investors, Goldman Sachs, Morgan Stanley, Warburg, et cetera, on looking into emerging markets like Indonesia, I think there was 1 million smartphones and users in market. And so I thought it was a little bit early, hence I came back to Silicon Valley, and I was a founder and CEO myself for a number of years. But it was in 2015, once again, that serendipity brought me to Indonesia, and that a dear friend of mine from Hong Kong said, you should really talk to my college roommate. And I said, why? And he said, hey, he's leaving Goldman Sachs, where he ran private equity and venture capital in Indonesia. And hey, he understands Indonesia, Southeast Asia. Eddy understands Silicon Valley. For the last 20, 30 years at the point I'd done, lucky enough to do PayPal, Firm, Palantir, SpaceX, et cetera. So I initially, just had some casual dialogue, and what we realized is it was, from a demographic perspective, it was a market that was quite untapped, right? A country of 300 million people with, allegedly, it's still on track to be the 4th largest market in the world, and it was very early in the ecosystem, if you will, at the time. In 2015, the aggregate capital raised in Indonesia the prior year was $150 million. That's like a seed round in like an AI company or whatever, yeah. So at any rate, so we thought we could bring something very unique to the table, both a global view, we ultimately brought in about 50 different firms as investors in our firm, like a founders fund, et cetera. And then we had, very good local distribution, really thanks to my partner. For good or bad, it's a country in large part, dominated by 50 to 100 diversified conglomerates, where we ultimately brought in about 40 of them as investors in the firm. So we could really win on the distribution side. We could win on the financial capital side by, call it being the Indonesia beachhead strategy for a lot of the top fund managers in the United States, where 40% of our deals is led by Silicon Valley funds, thereafter many of which have never stepped foot in the country. And also on the human capital side is really a thesis that I put out in Forbes magazine in 2016. At the time, there's 3 companies that valued over 100 million in Indonesia. Today, I think let's say it's 100, although it may have come down a little bit, the recent market downturn. But we had a thesis that, any emerging market, like it or not, generally is played out by what we call sea turtles, people from the home country, understand the local norms, but get some global exposure, get some inspiration from Silicon Valley. And if I think back to me growing up in each of Silicon Valley and Taiwan, Silicon Valley, in the 1980s of Hsinchu, Taiwan, where Morris Chang, came to the U.S., was at MIT, Harvard, Texas Instruments, and went back in 1984-85 to build TSMC to a semiconductor monopoly, $1 trillion market cap. And so we saw that the first 7 years of that ecosystem heavily driven by what I call sea turtles. But thereafter, once you had scale in market, the next generation of founders didn't necessarily need to study the U.S. and get inspired. We saw the same in China from 2000 to 2005. I covered folks like Neil Shen that studied at Yale, then C-Trip, and then ultimately Hongshan or Sequoia China, right? So in Indonesia, we predicted the future, and I said that I would come on campuses like Georgetown, where I spent a month or 2 throughout the U.S. So tomorrow, we got HBS next 2 days, and it played out just like we planned. In that the first 100 companies with a valuation over 100 million, I kid you not, 90% of those founding teams studied in the United States. So I think we just pieced together all these pieces and made a bet, and 5 funds later, so far so good. But like earlier, I think some of our portfolio founders says, I'll let you guys know it, upon the end of fund life or upon exit.
I mean, I love hearing that story, because it's a story about a venture fund, but it's a startup, and it's a story about entrepreneurship, and even though Collaborative is worlds apart, not investing in Indonesia, I think there are some similarities in that, I saw an opportunity that felt underserved, and I'll try to kind of condense it, but I think at its most simplistic form, it felt like, as an entrepreneur myself, prior to starting Collaborative Fund, it felt like the world was changing. The types of businesses that were being created didn't fit neatly. You had, 50 years ago, you had for-profit companies like Coca-Cola, whose sole purpose was to sell as much soda as possible and generate the greatest returns possible. And you had nonprofits like the Red Cross, whose sole purpose was to try to save as many lives. And the capital sources for those two different types of organizations was very clear. You had venture capitalists, private equity, credit, banks funding for-profit businesses, and you had, endowments, foundations making grants to nonprofits. But there was this emerging kind of class of entrepreneurs and businesses that didn't fit neatly into either of those. Like when I started Collaborative, it was at a time when Etsy and Meetup and Kickstarter, like when I first met the Kickstarter team, they didn't fit neatly into either of those. They were like, hey, we met with a bunch of venture capitalists, and the VCs were like, what's your business model? What's the market size? What's your unit economics? And Perry was like, what? I don't even know what you're talking about. And they were like, you sound like a nonprofit. You should go talk to a foundation. So they went to foundation, and the foundation said, oh, you got to fill out this grant-making paperwork. And they were like, we don't want to do that. And so they were kind of at the intersection of for-profit and for-good. And I was really attracted to that. So that was kind of the genesis. Felt like there was this new wave of companies that were at that intersection and didn't really have a source of capital to kind of meet them where they were. So, yeah.
Craig, to follow up, many investors view CPG brands as non-defensible, and you've succeeded with Olipop and One Trick Pony peanut butter. What defensibility factors do you look for in consumer products?
Yeah, it's a good question. I mean, I think investing in consumer it's really funny because for people that aren't in consumer, they're like, what are you doing? It's so easy to, copy. There's no moat. Consumers are fickle. Mm-hmm. And so what that leads to is a lot of really smart investors going to the enterprise and leaving this void, in consumer. So Georgetown graduates, I was an early investor in Sweetgreen. It ties back to a question that you asked earlier. Sweetgreen is a community. Mm-hmm. It's not a salad company. It's if you meet people like, I don't know if you remember that back in the day, it's kind of a funny thing, but the Live Strong bracelets, do you remember those yellow? It was a rubber band. But when you saw somebody else wearing a Live Strong bracelet, there was like a head nod, like, oh, you're into, fighting cancer, so am I. It's like, it was like a self-recognition of who you are. Mm-hmm. And so I think about that. I mean, I think some of the companies, that we've invested in, it's really about the underlying community that they're building. Olipop is a similar thing. It's delicious soda and prebiotics and all that, but it really speaks to kind of what your values are when you choose that consumer product. Yeah.
Eddy, do you have examples of when a globally proven business model didn't work in the Indonesian market or vice versa?
Yeah, I think absolutely. What we found, in a lot of emerging markets, I don't care if it's China, it's India, I think, SaaS is still very much a work in progress. The whole concept of paying for software, maybe it could be a function in emerging markets, the efficiencies, removing that one admin, whereas in Silicon Valley, that fully loaded costs you $100,000, $150,000, where maybe in Indonesia, it's $100, $200 a month, right? So what we found is for a lot of businesses that are more focused on, I think, workflow and efficiency, sometimes they're not necessarily the best fit for emerging markets, or ad-based is another great example, right? Where when I started the firm in 2016, 2017, yes, I think Facebook and Google's probably call it third biggest market outside of US, India, obviously can't operate in China, but would be Indonesia. But one of the biggest challenges when you ultimately looked under it, let's say Google AdWords or Facebook ads, or the amount of revenue, just such a fraction. So when you're operating in a lot of these emerging markets, often you have to go more in the direction of micropayments versus selling on eyeball, which is selling ads. Mm-hmm. So I would say definitely on the ad side, it's been very challenging. A lot of these, if you want to call it media businesses, it's been a little more challenging. And on the front end also, I think the traditional models, like the copycat things, I think Internet 1.0 in Indonesia, yes, you had e-commerce. So you had Amazon in the US, you had Alibaba in China, you have in Indonesia, you have Shopee, you have Tokopedia. Internet 2.0, then you ultimately have, let's say, logistics, and you need payment processing. So yes, that's great. But once you get past that, for us, one struggle the last couple of years is really to understand, once you're past these like baseline models, there's nothing left to call it copy. Where's the opportunity set? And I think you got to ultimately then dig deep and understand where you could be a global champion. And so if you think about Taiwan, it's semiconductors of the world. In the context of the Nordics, maybe it's gaming as well as, Spotify. In Israel, it could be, cybersecurity of the world. India, maybe it's SaaS of the world. In our case, we ultimately landed on natural resources, right? Where the country does have a large source of called nickel in the world. Also the longest coastline, so we can do very interesting projects called blue carbon, where there's a global demand from multinationals like a Shell, BP that want access to credit, whereas on the supply side you have government with initiatives to plant trees, mangroves, et cetera, or aquaculture or agriculture, where people don't realize this, but Indonesia produces 40% of, call it the seaweed in the world. So we have a GMO seedling company where the Seaweed Trade Association team decided to now, as opposed to people reharvesting existing seaweed, no different than my mom still, like sometimes cutting some onions and putting in a little called cup. In this case, GMO seedlings that generate 20 to 40% better yield, that then in turn we guarantee the farmer X amount of dollars, where historically very volatile pricing, and then we bring that global once again for textiles, call it pharmaceuticals, and candy. So getting back to it, I think the stuff that's more operationally efficient, that doesn't work as much in our market, nor stuff that's ad-based.
Tobi, I have a question for you now. You've talked about the potential for AI to revolutionize music, comparing the current state of music AI to Napster and early streaming days. How do you see AI disrupting the music industry over the next decade?
Yeah, it's a great question, and I think to set the foundation for everyone, this interest really came in the overlap between AI and creative tooling or creative pursuits. Our first investment in this space was with Runway, that I mentioned previously, in video generation, and so that sparked our interest, and then we started to think through, okay, well, what are other modalities within the creative space that AI could have a hand in influencing, and audio is clearly one that has taken off. I mean, companies like 11 Labs and Cartesia have done a tremendous job in providing the back-end audio for a lot of these companies that are building on top of them. Another area that I'm personally interested in, and that I was interested in from a business standpoint, is music, right? I think Napster and Spotify really did a tremendous job in changing how music was distributed. And you see it influenced in music today. I don't know if you guys noticed, but like albums are longer and shorter, and songs are shorter, because artists get paid on a per stream basis, right? So you get 20 song albums, and each song is 2.5 minutes, as opposed to the average song length used to be 4.5 minutes. And so that's a cultural change that's a result of technology. And so that sort of bred a thesis in, okay, well, how is AI gonna influence this space? And I think it's early innings, but the hope is you can help in democratizing how music is made, right? You don't need to go to a producer and lobby for production time and work with these antiquated software that takes all this time to create good music. You can do that with your laptop and with the tools that you have available to you. And so we view it as enhancing the music creativity process, and then it might have second and third order effects in terms of how rights are distributed and things like that. And so we made investments, it's actually not public yet, into a company in the AI music space. There's a company called Suno that's growing very, very quickly. And so we'll see, but we're excited about the potential there.
Awesome.
So you talked about AI being a vehicle that shortens the distance between ideation and execution and realization. To the panel, have you seen more founders who may not necessarily have very technical backgrounds who are using AI to create products and companies in ways that they previously may not have been able to?
I mean, it might not be the most exciting, but yeah, there's a company in our portfolio a consumer business that, candidly, they couldn't get their unit economics right because customer support costs were through the roof. And more recently, they've started to implement certain AI tools that have brought those, customer service costs way down. Like they're able to solve something between 60 to 70% of the, customer support tickets without a human actually getting involved. And that radically changed their business in a way that now they're profitable. So it's not sexy, but it is. That's just one tiny example of how a company can smartly use a tool in a problem area. Like if you think of a business as a boat, like there was kind of a leak in the boat, and this tool was able to help them kind of solve for that. So.
Yeah, we've also had, anecdotally and within our portfolio, you can get to MVP much faster. Founders can use that, maybe didn't spend 3 to 5 years learning the tricks of the trade of engineering. You can use Cursor and some of these other engineering tools to really act as a pair programmer to get to a point where you can have an MVP, put it out in the world, and people can give you feedback and iterate on it much faster than, back in the day, it used to take months to build your MVP, and sometimes you would have to outsource it. So there's numerous examples of founders that have been able to bootstrap to an MVP, get feedback, and just move more quickly using these pair programming tools.
Great. Now, with many arguing there's an excess of dry powder in the market, is there a real shortage of top-tier talent for VCs to deploy capital to, or has the noise level just increased due to AI making it easier to build and launch startups?
I think there's always a scarcity of the most exceptional founders. So I don't think it's new. I think sometimes though, when you have something as exciting as AI, and this is good, there's a lot of enthusiasm, there's a lot of desire to build, but at the end of the day, like I said before, it's a long journey. And fundamentally, we are looking for founders who have a certain insight and an authenticity as to why they are endeavoring on building a company. And so it's great to get to MVP, it's great to get to demo, but if you're talking about taking institutional funding, the journey from an idea to actually a disruptive outcome, whether it's going public or distributing dividends as a private company, or being sold at a disruptive price, it's a very long journey, and it's really, really, really hard. And so it's exciting because the level of innovation is so high. There's strong passion and desire to build and keep innovating, but the core job of creating an enduring business remains incredibly hard and really challenging. And so when you think about the most exceptional founders, there's not enough of them.
Yeah, so in terms of, I can comment a little bit, I think outside of Silicon Valley, at least in emerging markets right now, I think you saw, just like America, a lot of things peak out in 2021 and 2022, but in our market, at least on the Indonesia side of our business, it is a market that we've really seen a major kind of funding winter, in that the volume of venture capital dollars going in every quarter has gone down for 11 successive quarters. But getting back to, I think as an investor, given our market once again just has 100 deals, and we're finding teasing out the why in the founder is a lot easier versus in hot markets, everyone has a great resume, and it's very difficult to tease out the why. So those that are out in the battlefield probably are for real. We're able to really diagnose who are the fake founders and who's for real, at least in that on that end. And then on the U.S. side, yeah, I mean, certainly on the AI side, I personally am finding, including the companies that presented earlier today, many of which are in our portfolio, there's a lot of interest, obviously in stuff that is dual use in the near term because of the success of some of the companies that had the fortune to be a small investor in, whether it be PayPal, SpaceX, and Palantir. And so it'll be interesting to see how things play out. But maybe, as Jake said, maybe it's overly hot, and people are chasing, particularly given some of the recent announcements, I guess, on budget. Although maybe, despite cuts back in the budget, maybe it's going to be redirected at, to call it the neoprimes or whatever it may be.
So, with so much competition for a limited supply of founders, as a VC fund, how do you differentiate yourself to add value and win those deals?
Is that to me?
That's to the panel.
I'm happy just to, on the Indonesia side, it's pretty straightforward. I mean, we are the only Indonesia-only fund. So from a differentiation perspective, this is the only product. Now, of course, there's Southeast Asia funds that do some Indonesia, but we just do one thing on the menu. So for that, I think it's really played out in that run a super concentrated portfolio where in 8 years we've done 30 investments, where some of my peers that did 50 deals in 1 year in 2021. So I think for us, I think it's hyper local where having 40 of the top 100, groups in the country invested, we meet you, date you, take you to the customer, meet the family, and if that checks out, that's our diligence. And if you ultimately don't take the term sheet, then you're kind of a bad actor. So our win rate, to that end is, I think, like 96%. First 2 years of the firm, maybe 67%, kind of new kids on the block, did some interesting stuff individually, but as a team, you're unproven. But if you look 9 years into it, I mean, our retention's 100% at a team level, and from a win rate, it is 96%. So that's on the Indonesia side. And then in terms of on some of these more, if you want to call it, dual-use business in the U.S. side, I think it is just been fortunate, made a lot of mistakes and a lot of bad investments, but I do some of those lucky investments or early wins, call it 25 years ago, kind of built trust where, with PayPal we had the fortune, back in the year 2000, if you read the book Founders, it talks about some of their trips to Asia, and it was with, myself and my family, and so we were kind of fortunate to build upon that where it's a childhood dream where 30 years ago when I was some of the students' age here, 19, maybe I could deliver U.S. to Taiwan. Those are countries that I knew best, given being a citizen in both. But building out Intudo the last 9 years, bring the world to eat Indonesian fried rice and Indonesian fried rice to the world, it's allowed me to cover quite a lot of ground across many countries. So today, from a positioning perspective, at least on some of these more dual-use businesses, many of which are, our alum here, Trey, is on the board of, dear friend of mine, we're able to partner and really be that trusted partner for both go-to-market domestically, but more so, I think, globally to U.S. allies. So I would argue almost, Asia ex-China, plus Middle East and Europe. And I think that's from a position perspective where we have a pretty unique edge.
I'll go next. So we make conviction-based investments, and we got to be super excited about it. And I think that it just says we look for authenticity, and our founders, I'm sure they're looking for authenticity and conviction as well. And so, we were excited to see that Alan Patricoff spoke earlier. So he is one of the co-founders of Greycroft. But what I would say is that we've been around since 2006. And so we have a really long heritage and track record. But we're still small. Our most recent fund is, well, I don't know, small is relative, I guess, but I think Eric and Kara were talking about the mega fund. So we are small relative to the mega fund. So our most recent fund size is $1 billion, and we focus on software and AI. But I think what that allows is we have a long history and track record and heritage, but we're still a boutique. And so when you work with us, you're working with the partnership and you're working with the founders, not a sizable platform team, for example. And so I think it's that combination of personalized support. I would say like the other thing is we have a really long-term approach and pretty low ego and collaborative approach with founders. And ideally, like, yes, we all talk about the value we bring to bear, but it's also, if you're investing in exceptional founders, you also need to know when to get out of the way. So there's an element of get out of the way, let them do their thing, remove the obstacles, but then obviously having been around and been company building across many different founders and companies and portfolio companies is providing that advice as well. I think, we are New York, LA, and San Francisco, and I think that provides some unique ecosystems to bring to bear for our founders. But I think at the end of the day, I always ask myself, do I want to work with this team on this problem 24/7 for the next 15 years? And if the answer is yes, that is very high conviction, and I think it shows to the founders.
I'll go. I guess I can provide a similar perspective. We're an $830 million fund, so similar size, but 10 investors, been around since '06, $3 billion under management. I think it's a very competitive market. I think you try to control what you can control. You can't be everything to everyone, and be excellent at the things that you do. The strategy that we've taken since the early 2010s is to really just try to be as founder-friendly as possible. And we have two set programs. We pledge 1% of the capital in the first round to the founding team. We also vote our shares with the founder. So that resonates with founders. To Marcie's point, like sometimes the best founders just want you to get out of the way. And if you allow them to, if you run a good process, you treat them as equals, you care about what they're gonna say in the marketplace to other founders, that resonates, and your reputation goes a long way. And then you enable them to keep control of the business. That really generates alpha for us. And then you are able to build up a portfolio where you can say, hey, you're an AI company, we've got these set of companies that can benefit your growth or something like that, or this founder that's gone through this particular journey. So I think caring about where you are in the marketplace helps you build a portfolio that then helps you win over time. But it's always a battle.
I'll take a slightly different, just to spice things up. I feel like the room needs a little bit of, the people in the back may be a little sleepy, so I'll take a slightly different approach. I think venture means, again, like going back to the comment earlier about AI just as this amorphous thing, so is venture. Early stage venture is very different from late stage venture. And so if you think about the job of an investor at a General Catalyst or a founder's fund, and I'm oversimplifying here, but just I think for the sake of painting a picture, their job is much more about waiting to see what's working and then competing really hard to get in it. So it's like Airbnb is off to the races. The revenue is scaling. This business is clearly going to be a killer. Now I got to go in there and fight and prove that I can add value more than him, her, him, and her. Very, very different as an early stage investor. Your job, it's interesting, the deals that have generated the greatest returns aren't necessarily competitive. You're picking things that other people don't see. It's like going to a garden before the flower has bloomed. And so, when we invested in Olipop, everybody else had passed. It wasn't that we were there and said, hey, here's all the bells and whistles of how we add value. We were just the only ones who offered them money. Mm-hmm. And so I think how you add value differs depending on the stage. So anyhow.
Awesome. I want to kind of, to that same vein, shift with a fun question. What's the best cold email that each of you guys have received before? Subject line, photos,
content,
weird hobbies.
Yeah. Okay. Actually, Drew Peterson sent me an email to speak here, and it was so well written.
Oh, good.
That I'm here.
Woo! I hope he heard that.
I don't know. Is he here? Is Drew here?
He's probably getting ready, but we'll make sure to pass along the message.
From a cold emails are hard from a founder, I think.
Is there anything that makes you open? Is there a subject line that you look for?
Okay, I have to be honest, I don't read them.
You don't read them. All right. That's fine. Yeah, that's an answer too. All right, Eddy.
I think just personally, it's pretty amazing. I think it's like 90% of the cold emails, like there's zero effort that the person's put into it. And it's very clear that it's been sent to, well, I mean, in our firm, there's probably every single Southeast Asian fund or whatever. But I do think that even when people put just even like a light touch, like whether or not they actually watched whatever podcast or whatever, but they capture a couple nuggets, then yeah, generally, I mean, I try my best. I feel if it's like somebody more of a peer like my age, then within reason, but definitely for younger people, people reach out. Like I spend a month or two on campuses throughout the year, Georgetown, this weekend's HBS or whatever, and I offer my phone number. And honestly speaking, only two types of people are like call me up on it. It's either people are horrible or people are really, really good. But getting back to it, yeah, it's very binary. That just like asking. But getting back to it, I just feel that the amount of effort's not that much, and just putting a little ounce of effort, I always will respond in that case, as long as it shows that they actually invested in something other than just like a copy and paste. So personally, because just you got to show up, and I used to say, like, at least when I was in college, if you want to meet a boyfriend, girlfriend, whatever your flavor is, you kind of got to show up to the event or the party. Now, obviously, nowadays maybe you can swipe left or right, but getting back to it, what do you call it? Yeah, so I would say just any ounce of effort, and the bar is so low, you'd be surprised.
Can you tell if they're AI generated these days? Is it really obvious?
Yeah.
I would say in the last year it's gotten, sometimes
Pretty bad.
over the top, and we have an internship program, and I would actually argue that the ones that are too good, it actually maybe for us and my team, it actually deters us from being
Fair.
more excited to interview them. Yeah.
Yeah.
I just to speak to that, the more verbose they are, the more like it's probably AI generated, or if they're using like really big words, like just in an email. The best one, I've gotten two recently that were pretty good. They were short, like 3 sentences. One was from a kid from Berkeley, and he said, "Hey, here's my investment thesis, or here's like a presentation on me and my current investment thesis. Like open it up," or something like that. It was very casual. I was like, okay, I'm intrigued. I clicked on it. It was like this whole deck that he had made about himself, and then an investment thesis, and he nailed a company that we had just brought into investment team, and I was like, all right, like I'm gonna talk to you. So I think to your point, it's like all it takes is a little bit extra. I mean, you don't have to I'm not saying go out and make an investment memo about yourself, but like if you listen to a podcast we're on, or you actually checked out the website, you included that in the email. I try to reserve like one Friday a month, like my afternoons for cold emails, because the only reason I'm in venture is actually I cold emailed 2 people, and one of them got back to me.
That's the other question is, well, what's the best cold email you've written? And it goes back to what you said, which is, it is incredibly, like, for me, like, thoughtful. Like, I really want to meet with this founder, and so it requires effort. But yeah, now I feel bad.
Don't feel bad.
Because I've sent my fair share of cold emails.
Craig, anything
you
from
done,
you?
Tobi?
Yeah.
The only, I guess maybe the only thing I would say is it's actually less about the cold email, but more a story about putting yourself out there. I wrote a blog post years ago that was just it was somewhat controversial, and it was it was a take that I had that I'd kind of written initially for myself in my journal, and I decided to put it out there in the world. And lo and behold, the founder of a multi-billion-dollar company reached out and said, "Hey, I read this post. It spoke to me." And I think that taught me a lesson, because prior to that, I'm like, nobody reads this. Everybody's got a blog, like, but I think you'd be surprised, the dividends that it could pay when you kind of express. I mean, Tobi's story is a great one. In that case, it was 1-to-1, but I think, everybody's got a creative mind and spirit, so putting it out there in the world can sometimes come back to you. Yeah.
Awesome.
Stalking can also be an effective strategy.
Because we totally stalked you guys. I don't know who I was joking with before, but I said, how do I balance meeting you guys for the first time and knowing way too much? Any question for you? I'll ask one more then, if we have the time. Do we? What? All right, well, we'll do one more.
Yeah.
Quick rapid fire. best piece of advice you could give to the students in the audience who are looking to be kind of in your seats one day, or as a founder in your office pitching you? Yeah, Eddie.
I would say when you go to functions, don't focus on talking to the speakers. I would look around, talk to the youngest person in the room. That'd be my feedback. Is they're probably there for a reason. Often it's the speaker's kid. In many cases, that's my kid.
I would say learn as much as you can. Be constant learners. Take advantage of what you have here at Georgetown, but it's a lifelong endeavor, and I think one of the funnest things about being a technology investor is literally learning every minute of the day.
Yeah, just to add to that, I would say be authentic, and don't be afraid to lean into your past experiences and your upbringing. There's a lot of advice, and you try to fit yourself into a mold that's not you, and it's just hard, right? And there's a million ways to do this job, and there's no one way or one formula for success. So just focus on being you, and that'll come through.
I think Tobi hit the nail on the head. I mean, really, I think if you want to be a success, whether it be a successful venture capitalist or entrepreneur, you got to be true to yourself. Mm-hmm. It sounds cliche, but you'd be surprised. It really, I think the two pieces of advice that I give people is, one, be authentic, and two, just do what you say you're going to do. And that sounds crazy, but when the number of people who say, hey, I'm going to get that to you on Tuesday, it doesn't show up on Tuesday, you'd be surprised. So I think, when you commit to something, do it your best and be yourself. Yeah.
Awesome. Well, thank you, Craig, Eddie, Marcie, and Tobi. Give them a round of applause.